Good morning, my name is Przemysław Kwiecień, I'm Chief Economist of the XTB, and it's my pleasure to have you on our weekly trading webinar. This week we are going to quickly go through the last year, which was absolutely exceptional on financial markets. A year from crash, and we are in certainly a different place right now. So we quickly go through what happened, how the market turned from being extremely pessimistic to extremely optimistic right now, and what lies ahead. But typically, let's start from top news on Monday morning. Well, buy the dip is very strong tendency that keeps markets alive, and yeah, certainly it has impacts on, especially on the DAX that trades at new record highs. S&P 500 in the US also doing very well, returning to 4K, partly on slightly higher, slightly lower inflation that we saw on Friday. So definitely markets are still doing very well, and any outbursts of volatility are short term. However, having said this, on Friday we had mysterious block trades on media stocks, including Viacom and Discovery, that show how dangerous this market on steroids could be. Let's take a look at the platform to show you exactly what I'm referring to, and you can see here, because both shares are can be seen on the platform, and you can see Viacom shares, which is the symbol VAC US, and Discovery stocks as well. You can see this in blue, and you can see what just happened on Friday. It was absolutely incredible. Both shares struggled into Friday's session, but Friday was the culmination, and as you can see, especially for Viacom, that at one point the shares were at the lowest point since the mid of 2020. So obviously massive moves, and that's not what normally happens on stock markets. And yeah, obviously this was a purely a technical move. There is a speculation that the fund called Archegos got a margin call on these stocks, and that's caused the major sell-off. So what do we learn from it? Obviously, I do not expect this to have long-lasting consequences for a broader market, because these stocks are too small, and the move, like I said, it's in technical in nature. So as long as other traders discover, well, these stocks stumbled because someone had to sell them, because if you get margin call, obviously you need to either supplement additional deposit, or you need to sell some assets in order to cover that margin, and that's what happened. So probably others will realize that, and yeah, this will calm down. However, at the same time, with the margin debt to GDP in the US at the record highs right now, and the market so hot, this shows what the risk could be if something bigger take place. So certainly something to have at the back of your head. The media story last week certainly was the picture that you can see here, and many memes and jokes around Evergreen and Suez Channel. And yeah, it's the latest news is that it's about to be freed soon. So oil prices are down today, and and it's probably going for as soon as it's freed and the other vessels can go through, the attention will evaporate here. On the oil market, obviously it has short-term impact. However, I think for oil, more important is overall strength of the markets and sentiment, because as you can see here, like I said, with the DAX and other indices doing well, but the oil that was oil was doing really well, especially since vaccine news in October. So oil was in a very strong upward channel, and the trend was extremely strong here. But as you can see here, prices slid below, not only below the lower threshold of the channel, but also below the 50-day moving average, which now acts as a point of resistance. So yeah, technically it doesn't look very promising. We can see that these rebounds are not strong enough to to end this correction here, and right now it might look like in the near term this correction could go deeper, even if fundamentally the OPEC still seem to have control over the supply. So there is no reason perhaps to expect a lasting downward trend fundamentally. However, technically the picture doesn't look very well. And in calendar this week we have quite a lot of things, especially NFP on Friday. Friday is off on many markets in Europe. However, it has the major economic release this week, so bear that in mind. We'll discuss this in a minute. Okay, so let's start from the topic of the week, which is 10 charts on a year from crash. So as you can see here, we had really volatile March of 2020, but since then, as you can see, most of the markets have really blossomed, and even the weak markets like Spanish IBEX, they are still quite substantially off the lows, with the Spanish markets about 37-38% of the lows. And obviously other markets like Nasdaq or especially Russell that saw a big decline here, but since then it increased 120%. So big gains, despite the pandemic still being a severe problem globally. Markets left it behind a long time ago, and actually for most part, for most indices, not only managed to recover the losses, but actually are much higher. And obviously the reason for it is the Fed and what they did. They responded very quickly. They started buying a lot of assets. They started buying broader range of assets, including junk bonds, and provided a lot of liquidity to the market. As a result, we have the fastest bull market in history. As you can see here on these two charts, this one and that one, this is a rally from 1 year low, and this is a rally from a 2 year low. As you can see here, both rallies are exceptional from a historical perspective, especially this 1 year rally. It's a record high, record fast, and we never had a situation before where both rallies exceeded 70%. So this is the first time. So this is the fastest bull market in history. So like I said, even though the pandemic still roils societies, especially in Europe, it's still a big problem. But from market perspective, it's long gone. It's been supplemented by central bank policies that drove the market so much higher. But the point is that with indices being so high, like I said, DAX, at the record highs at the Friday close, S&P 500 back at nearly 4,000. So as you can see, even small correction attempts lead buyers back, because people believe, after such a strong market, people believe that this is just going to persist long into the future, that with central banks so aggressive, with money around us with 0% interest rates, this needs to last. And the market there is not even a big correction. The last substantial correction was in October on the most of indices, as you can see here, towards ahead of US elections. The S&P 500, on the DAX, the same story, ahead of US elections, with also the second wave pandemic in Europe, and the third wave actually went unnoticed. Even more, I would say, traders welcomed it, because they thought, okay, we're going to get even more expansionary policy. So I think the problem that most of the investors will have, or they have right now, is that what to do with all these gains, with markets being record expensive. Because if you look at many indicators like price to earnings, price to sales, margin debt to GDP, they are at the highest level in history, and in some cases by a good margin. So the question is, how, with market already being so extreme, can it still keep going? Because that seems to be the consensus right now. If you look around, if you read what the strategies from the big banks, institutions, what they are saying, nearly all of them, they say this market is set to continue, and yet all these indicators are already red hot. So the question is, for investors, for how long can it stretch these valuations? And obviously a lot will depend on the monetary policy, because the Fed tells us, look, we are going to keep interest rates at 0% for many years ahead. And as you can see here, obviously that had a lot of impact. Here you can see the key of top 3 central banks, and obviously this helps funding huge deficits. And even with this big QE for next month, as you can see here, the Treasury in the US will need to borrow from the market. The QE will not be enough to cover all of the financing needs this year. So the result is bond markets sliding, and the risk is that if inflation is too high, the Fed will not be able to help the US government fund the deficit, and at some point this is the biggest risk for the markets, because as you can see here, the bond yields have been on the rise. We can take a look at the gold market, because here we can clearly see a relationship between bond prices and gold. And as you can see, bond prices keep sliding down, and the latest peak up here was short-lived. Again, on Friday, bond yields increased, so the bond prices declined. And while on some markets like gold or euro dollar, this has a strong impact, because these markets have strong correlations even in the short term with bond yields. Broader equity markets have broadly ignored this. Like you can see, S&P 500 still fairly close to all-time highs despite this rise in bond yields. So the question will be, will these bond markets eventually bite the broader markets and sentiment? I think this is the most important part to look for in the months to come. And inflation and everything that relates to inflation will be very closely watched, because it will decide the fate of the markets this year. And finally, I already mentioned the dollar, and obviously the consensus was that the dollar is set to weaken, because obviously during the height of pandemic it was very strong. It was strongest in history, measured by trade basket and using real rates, so it's inflation adjusted. And obviously it's moderated. It has moderated since then, but it's still relatively expensive. I would say even quite significantly expensive from a long-term perspective. However, this seemed to be a good lesson for us, that many people expected the dollar to set to weaken over time, and yet it comes back. Yes, as we can see here on the euro dollar, it's already a trend reversal here. Maybe against the pound it's not so pronounced. Long-term channel on the cable is still upwards, and what we can see is you can say it's only a correction within a channel. However, also here, that the risks are growing that it eventually could lead to a breakout of this channel. So I think this is the lesson, that while once it starts biting, it can have serious consequences. And the same story applies to indices, that for a long time people expected the dollar to weaken and eventually it's coming back on higher yields. So the same story could happen potentially to indices. Everyone expects them to go higher. So with this optimism and this overvaluation that you can see everywhere, it could eventually catch up to these markets as well. All right, so let's move to what's going to happen this week. Pretty much, yeah, we have a lot of publications. We have a lot of publications between Tuesday and Friday, but to me, actually, it's not the NFP that's the most interesting, but ISM that we're gonna get on Thursday, because as I said, and you can already I think see why, this inflation story is the point for markets, and it's gonna be like this for the next few months at least. So in the ISM you can look for price component, and it was really pushing higher the past few months, and it's already closing in on the record point from 2008, when as you can see even on the extension platform, oil prices were close to 150. So these price pressures are, or at least they were growing up to February, and the question is it going to persist? Because if yes, obviously this inflation fear could build up on the bond markets. So this is why this is the most important publication for me this week. NFP, obviously it's still something to have an eye on. We had a good report last month, but still you can see the gap to recovery is huge. However, from the market perspective, short-term market response, well, it's obvious for the dollar and the bond yields. If the report is good, the dollar is going to keep gaining and the bond yields will be increasing. However, for indices, it's less clear, because if the report is good, you can say, well, it's a recovery. If it's bad, you would say, well, but the bond yields need to decline and it's going to be a relief. So for the indices, it's not so clear. For bond yields, euro dollar, gold, it's pretty clear cut. If the report continues to be good, it's going to be push perhaps bond yields somewhat higher, and it's going to be negative for gold and euro dollar. So for these markets, yes, this report will be important. It's going to be Friday. So ladies and gents, that's it for today. I wish you a great Easter, because we're not gonna meet until then, and we're not gonna meet on next Monday because it's the day off here. So please stick with us. In the news section, we're going to cover, including next Monday. So have a good time, and we'll see each other in 2 weeks time. Bye.